The check cleared on a Tuesday. After 18 months of internal complaints and quiet retaliation, Sarah Chen had finally signed her severance agreement, $47,000, and a promise to stay silent. 43 days later, her former employer's attorneys sent a certified letter. She had allegedly violated the non-disparagement clause. They wanted every dollar back. What they didn't know, what would ultimately destroy their case, was that Sarah had never stopped saving emails.
In corporate America, whistleblowers face a brutal calculation. Report the fraud, lose everything. What happens when one accountant refuses to accept that equation?
Sarah Chen joined Vantage Capital Partners in 2018 as a senior financial analyst. By her third year, she noticed patterns that didn't add up. Revenue booked before contracts were signed, expenses buried in subsidiary accounts, numbers that looked clean in the quarterly reports but didn't match the raw data she ran every morning. She raised it with her direct manager. She was told it was a rounding issue. She started saving emails.
In March 2021, Sarah filed a formal complaint with the CFO's office. She documented 11 specific instances of what she believed was premature revenue recognition, a violation of GAAP accounting standards that would later attract SEC attention. The CFO's office acknowledged receipt of her memo. 72 hours later, her manager called her into a conference room and told her that her position was being eliminated. The company called it restructuring. Sarah called her attorney.
The separation package came with conditions: a lump sum payment of $47,000, 60 days of continued health coverage, and 2 clauses that would come back to haunt both sides: a non-disparagement agreement and a clawback provision allowing the company to demand full repayment if she violated any term. Sarah's attorney reviewed it. They negotiated several points. She signed on a Thursday afternoon, cashed the check, and then made a phone call to a former colleague.
That phone call, a 7-minute conversation with a friend of 6 years from the company, was all Vantage needed. Their legal team claims Sarah had disclosed confidential details of her departure, a direct violation of the agreement. The clawback demand arrived 43 days after the check cleared. $47,000 plus interest plus attorney's fees. For most people, that certified letter would have ended the fight. Sarah opened her laptop and started searching her archive.
For 3 years, Sarah had forwarded key work emails to her personal account, a habit she'd developed early in her career. When she was laid off, her archive held nearly 400 messages. Among them, a thread from October 2020 in which 2 senior executives discussed adjusting the Q3 numbers before the board presentation, and a December 2021 HR email referencing her fraud complaint by name, sent exactly 2 days before her position was eliminated.
Her attorney sent a single letter to Vantage's legal team with 42 of those emails attached. The letter noted that if the company pursued the clawback through litigation, the discovery process would compel full production of all relevant communications, including the ones Vantage's own executives had written. It also cited the Dodd-Frank Act's Anti-Retaliation provisions, which make it unlawful to punish a whistleblower for protected activity. Vantage requested a meeting within 48 hours. 14 days later, both parties signed a settlement.
Sarah kept her original severance. The company paid an undisclosed additional sum, no admission of liability, but the SEC inquiry into Vantage's revenue recognition practices continued independently. The lesson isn't about luck, it's about documentation. Every email, every timestamp, every reply. If these stories matter to you, subscribe new cases every week.